Let's talk about one of the most painful feelings in trading. You know the one, buying a stock at the absolute peak, right before it all comes crashing down. Today, we're going to learn how to spot these traps, and more importantly, how to sidestep them completely.
Seriously, have you ever had that feeling? You do all your homework, you finally pull the trigger on a stock that's on fire, and bam, the second you buy, it turns against you. It really feels like someone somewhere is watching your screen and waiting for you to click buy. It's so frustrating. But you know what? It's not personal, it's just physics. Market physics.
And this is exactly what happened to our friend Rahul. He was watching this stock, Desi Defense Ltd, just go vertical, day after day. His friends were bragging about their profits, the news was all hype, and that fear of missing out, FOMO, it just completely took over. So he jumped in, totally convinced he'd found a golden ticket.
And this was the immediate result, a gut-wrenching 15% loss, pretty much overnight. Yep, Rahul bought at the literal all-time high, and the market slapped him down for it, hard. His FOMO-fueled decision turned into a very expensive lesson. So what on earth actually happened here?
Well, to understand his mistake, Rahul went and found himself a mentor, this wise old trader they called the Guru. And the Guru told him about a super simple but really profound idea, the rubber band effect. This is the key to understanding why these huge, exciting rallies so often end in a sudden, painful reversal.
Now, the fancy technical term for this is mean reversion. Just think about it like this. A stock's price has a comfortable average, a mean, where it likes to hang out. And when it gets stretched too far away from that average, either up or down, there's this natural force that wants to pull it right back.
And the rubber band analogy makes this crystal clear. Imagine the stock's average price is your hand holding a rubber band. As greed and FOMO kick in, the price starts stretching that band further and further and further away. Rahul, he bought right when that rubber band was stretched to its absolute limit. And what happens when you do that? It snaps back, fast and hard. That snapback was his 15% loss.
Okay, so this is the key, right? If we could just measure the tension in that rubber band, we could totally avoid buying right before the big snapback. Well, guess what? A tool for that exact purpose already exists. You can think of it like a speedometer for your stock.
It's called the Relative Strength Index, or RSI for short. It's a brilliant little tool that doesn't track the price itself, but the speed and change, the momentum behind the price. It tells you, on a simple scale from 0 to 100, just how fast that stock's engine is running. Is it cruising along, or is it about to redline and blow up? The RSI gives you the answer.
So here's how you use it. It's really simple. The RSI has two big red flags. When the reading climbs above 70, we call that overbought. That means our rubber band is stretched way, way up. The stock is hot, it's getting expensive, and the chance of a snapback down is getting really high. On the flip side, anything below 30 is oversold. Now the rubber band is stretched way down. Everyone's panicking, and a snapback up is probably just around the corner.
So, back to our story. Any guesses what the RSI was for Desi Defense Ltd? At the exact moment Rahul clicked buy, it was 85. Not just overbought, extremely overbought. That rubber band wasn't just stretched, it was practically see-through and about to break.
And that's the question the Guru asked Rahul. It's just the perfect way to think about it. Buying a stock with an RSI of 85 is exactly like flooring the accelerator on a car that's already screaming at its limit as you're heading into a hairpin turn. A crash isn't just a possibility, it's the most likely outcome. A pro sees that reading and slams on the brakes. An amateur driven by FOMO, well, they jump right in.
Okay, so does this mean we should just sell every single time the RSI pokes its head above 70? Well, not really. A really strong stock and a powerful trend can stay overbought for a while. So instead, we can use the RSI to get way smarter about when we buy. It's about combining the big picture with the short-term timing. Let me show you a simple strategy.
All right, here's a three-step playbook. Super simple. First, you check the main trend. Is the stock strong overall? A great way to check is to see if it's trading above its 200-day moving average. If yes, great. Step 2, patience. You wait for the price to pull back. You let that overstretched rubber band relax and come back to a normal tension. And third, you use the RSI as your trigger. When it cools off, gets down to a much healthier level like 40 or even 30, that's your scientific entry point. It's a low-risk moment inside a strong uptrend.
So this really brings us to the main lessons from Rahul's very painful trade. He basically learned he was chasing the bus down the highway instead of waiting for it at the bus stop. But the guru had one last and really crucial piece of wisdom for him.
So, let's do a super quick recap. First, FOMO is your enemy. It turns you from an investor into a gambler. Second, remember the physics. What stretches too far will snap back. Third, use the RSI as your speedometer. Buying above 70 is like playing with fire. And finally, the strategy. Find a strong trend, then wait for that RSI to cool down before you even think about buying. But there's one last warning you absolutely have to hear.
And here it is. This is so important. No indicator, no strategy is a crystal ball. Even if you do everything right, you will sometimes be wrong. Sometimes what looks like a small, healthy dip is actually the beginning of a much bigger crash. This whole strategy is about improving your odds, but it never, ever eliminates risk completely, which, of course, leads to the final question.
So if any single trade can still go wrong, no matter how good your timing is, how do you protect your overall wealth? Well, the answer, as the guru would say, is to never put all your lottos in one box. We'll break down exactly what that means next time. See you then.